Hi, this is Matthew Cratter from Trader University, and today I want to talk more about what I think is coming next in the stock market. I've been getting a lot of questions about this, so I thought I'd make a video about it. If you're worried about this bear market or just want to see what I'm trading during it, be sure to hit that subscribe button. So in a previous video, we already spoke about how important and contested this 260 level is on the S&P 500. I'm looking at SPY here, which is the ETF for it. But you can see that this area was an area of support in early 2018. We briefly dipped below it in the fourth quarter of 2018, and then it's functioned as support since then. What has happened in the last couple of weeks, though, again, I'm looking here at weekly bars, is that we closed below this key level, and it looks like it's now beginning to function. What was previously a support level is beginning to function as a resistance level. And one thing I should mention is that when traders and investors don't really know what's going on, and it's very hard to wrap your head around what's going on with the current pandemic and the global financial crisis, when people don't really know how to value things and you're in sort of a non-normal environment, what traders will often do is just revert to the technicals. And that's another reason these technical levels become so important, because people do trade off of them. So we've already spoken about the 260 level, but something very significant and very bearish happened yesterday on the close. We got what's called a death cross. And it's called a death cross when the 50-day moving average of an index closes below the 200-day moving average. And you can see that happened right on the market close yesterday for the first time. Now, this is normally a bearish indicator, and it can mean the beginning of an extended bear market. This bear market has been sort of exceptional in that stocks, at least in the initial phase, fell faster than they did even during the Great Depression in the late 20s and early 30s. And so when the death cross can give fake signals. So you can see that we got a fake crossover in late 2018. Then we immediately got a bounce off of that, and stocks continued higher. So one way to define a bear market or a bull market is when stocks are trading above the 50-day moving average, or generally above the 50-day moving average. And the 50-day moving average, the blue line, is above the red line, which is the 200-day moving average. And if we scroll back, you can see that that's really been the situation for most of the last 10 years or so. We did get this fake out in the fourth quarter of 2018. So I guess the question now would be, are things more serious? Is this a fake signal? I do not believe it's a fake signal. I think this is the beginning of an extended move down, and that will probably take out the lows and see new lows simply because of the high unemployment, so many businesses and sectors having to be completely shut down, and the hopes of antivirals or a vaccine being many, many months out. I'd be very surprised, based on the scientists I've been reading, if we have a vaccine for this in a year and a half from now. Probably be even closer to 2 years. And antivirals are very difficult to find as well. So I would take this signal very seriously. I think we've had what you would call is an initial sort of, if you want to talk in terms of wave theory or Elliott wave theory, one move down, the initial move down, which was quite fierce. It was down almost every day, and now we're seeing sort of a wave two up, if you want to think in those terms, a dead cat bounce, an opportunity if you choose to maybe lighten up on equity positions. I think there's a very low probability that this turns into a V bottom and we go straight back up. And there are a number of reasons for that. So we've spoken about how traders look at different levels. So we've looked here at we have the death cross occurring. We have stocks trading below the red line, which is 200-day moving average, trading below the blue line, which is the 50-day moving average. That's all very bearish. We can also look at a couple other moving average lines just to see where they're all aligning. No pun intended. So here's the 20. Let's make sure this is the 20-day moving average, where I would expect us to bounce off of this level And I think it's significant that this is occurring right around the 260 level. A lot of people watch the 20, 50, and 200-day moving averages. So my guess would be that we bounce off of this level and we start another leg down. Now, the one thing that could stop this is a tremendous amount of money printing and a tremendous amount of fiscal stimulus, which we've already seen some of. But I think the slowdown in GDP is still much greater than any stimulus we've seen. And the Fed can move fairly quickly, but Congress seems to move fairly slowly. So I'm expecting another leg down from here based on the 20-day moving average here. If we close above this for a couple days, that could be a slightly bullish signal. But I think what predominates is this death cross. One more chart I wanted to show you. This is the people, as I said, look at the 20, 50, 200-day moving average. This is the 200-week moving average, which is often cited by traders. And if we scroll back out, we can see that this has been support really throughout the last 10 years. We did break below it a little bit during the European crisis in late 2000, call it the summer of 2011. But ever since then, it's functioned as a very good support level. So at the end of the sell-off, at the end of 2015, early 2016, we found support at the 200-day weekly moving average. And again, we found support there in the fourth quarter. I think the market bottomed the day before Christmas in December 2018. And what we're seeing now is just a complete taking out of this 200-week moving average. You can see how smooth it's been. It's been a very good trend following indicator. But I think what's analogous here is that you can see how we broke below it during the great financial crisis, and then we had a bad couple years below it before we were finally able to regain it. After a 10, 11-year bull market, you would expect to have a bear market. And so the timing is right as well. And the fact that we've broken below this 200-week moving average, in fact, we didn't even, we tried to bounce, but really took it out pretty hard. And now we've rallied back up to this level. The 200-week moving average currently sitting right at, call it 264 or so. And so this is another indicator to me that we're going to bounce off of this and go lower. Now, conceivably, if there's enough fiscal and monetary stimulus, maybe we don't take out the lows and we just bounce around in this nether zone as we're hit with good news and bad news. The coming weeks, I think, are going to be particularly difficult in the U.S. We're really going to see the peak usage of the healthcare system and the hospitals in terms of there being enough beds and ICU beds and ventilators. We're going to have some insight into that in April, and I'm expecting, based on everything I've been reading, April to be a much worse month for this. It's going to be very difficult for anyone to go back to work, for anyone to go back to school. And so it's very hard to see anything that could drive stocks higher here. And so I'm expecting we'll bounce off this 200-week moving average and then either enter a volatile sideways market, or more likely, I would say, is take out lows, because this really, what we're entering here really is a global recession, a global slowdown, a global financial crisis that appears to be even much bigger than what happened in 2008 and 2009. Again, the one thing that can stop this is just excessive Fed and other central bank money printing, really just pulling out the stops. Sending $5,000 or $10,000 checks to everyone in the form of UBI, Universal Basic Income, or just printing a lot of money, money printer go burr, and using that to prop up the stock market. If that happens, we could see a bottom in the stock market sooner if you see really aggressive action from the Fed. But what that is going to do is it's going to drive gold and Bitcoin much higher, and they will probably move up much faster, particularly Bitcoin, because it has a very small market cap, only about 100 billion. It's much easier to move. And so you have this choice where if stocks go up, you're probably better off being in gold and Bitcoin. It would be very difficult for the Fed to get stocks back up to new all-time highs within the next 12 or 18 months. That seems impossible to me. If they manage to do it, the only way they can do it is through money printing. And you're going to see Bitcoin go from about 6,500 where it is now to well over 200, 100,000, 200,000 if the Fed pulls things out quite that hard and runs the money printer quite that hard. In fact, you could see quite an overshoot. So the Plan B model has us at about 100,000 by the end of 2021. If this guy keeps cranking on the money printer, you could really see an overshoot to the upside. You could get as high as 200,000, 300,000, 400,000 on this wave higher in Bitcoin. And so I still think I think Bitcoin and gold are probably the two places to be. I would expect Bitcoin to outperform. If you're interested in shorting the stock market, if you're a really aggressive trader and are willing to take the risk, this is not a bad risk level here. And if you get a daily or weekly close above the 200-week moving average, that would be a sign to cover the short. In this environment, when we have a very high, when we have a high VIX level, it makes it problematic to use puts because they're very expensive. VIX is still above 50. And so my preferred way of doing this when I short in an environment like this is to use the S&P futures, the S&P E-mini futures or the micro E-mini futures. Now, futures trading is its own beast. You have to be very careful and not use as much leverage as the exchanges and as your broker will give you. I have a course on futures trading if you really want to dig into that. Even if you're not planning on trading futures during this financial crisis, Learn to Trade Futures Like a Pro will help you prepare. And especially if you're quarantined now or you're staying at home and you're bored and you're tired of watching Netflix, it's really a great time to pursue self-education. I've been doing a bunch of online courses and YouTube videos as well. And so it can be a nice quiet time to learn some stuff. So if you're interested in checking out my courses, you can get access to all of them, all 12 courses, for just $125 tuition for 30 days access. Now, there are no long-term contracts or anything, and you can watch all the courses. You can sign up, watch all the courses, and cancel before the 30 days are up, and you won't get charged again. Now, I'm actually running a price sale on this simply because these are difficult financial times. So if you just hit the link below, go to this page, click Get It Now. It will take you to this page, and I'm going to give you a discount code, a coupon code you can use. If you scroll down here where it says have a coupon code, you just type in YT99. Click Update. That'll give you access to all the courses, including my cryptocurrency Bitcoin course. You can see you can actually see inside one of my accounts for just $99. Again, you can cancel at any time. And while you're in there, you might enjoy as well checking out, if you enjoyed this lecture and want to learn more about how markets work, price action trading, this course would be a great one to check out while you have your subscription, as well as Learn to Trade Stocks Like a Pro. And then if you want to start to use a little more leverage, again, there are the options courses and the futures courses, as well as a financial statement analysis course, which can teach you some of the basics of reading up on the fundamentals of a company, as well as sort of a more value investing approach. Hope you found this video helpful. Hit that subscribe and like button if you did, and let me know your questions or comments in the comment section below. Hope you're all staying healthy and staying sane, and thanks again for watching. I really appreciate it, and I'll see you in the next video.